And thanks very much to Andy for coming along tonight. You'll all know that he's the Chief Economist at the Bank of England. He grew up near Leeds in Guiseley in a working class home. He managed to do economics at Sheffield and Warwick, even though he didn't do A-level maths. He said he gravitated to the Bank of England. He's been there all his life, partly because there was no Bank of Yorkshire. He sits on the Monetary Policy Committee. Has written a staggering number of articles and books and numerous speeches, often with teasing titles, such as one he gave this year called The Dog and the Frisbee. He's the founder and trustee of something called Pro Bono Economics, which we might want to talk to him about. And as much as is unexpected about somebody carrying this august title. He spoke in favor of the Occupy movement protesters in 2012, said they were right to criticize the global financial system. He wrote a big piece in the London Review of Books criticizing the huge sums paid to bankers. And he's, of course, recently has spent a lot of time thinking about what the world will look like after the pandemic. He, of course, has to watch what he says because markets can react. But the Daily Mail has called him Mr. Boom as opposed to the Prime Minister, who's Mr. Doom. So he's trying to find the cheerful news in what's going on. So, Andy, welcome. I wish it could have been in LMH itself, but this is the next best thing. Perhaps I could start with the Queen's question after 2008. Why did no one see this coming? And I'm wondering the degree to which anyone at the Bank of England had planned for anything like this.
Thanks, Alan. Fantastic to be here, and thank you all for taking the time this evening to come along and listen and hopefully ask some questions. I'll try and provide some answers where I can. Well, I think, thinking back 10, 12 years ago now, I think there were some people who had some elements of the story right, that had spotted that things weren't quite as they could and should be financially. I think some of those people were probably even at the Bank of England. I think what everyone failed to do really is to join the dots, Alan, sufficiently, and therefore get anywhere close to predicting the scale of the cliff edge that we saw then. No one had really appreciated just how joined up the global financial network had become. And certainly no one had made the leap, the logical leap, to the view that a joined up network, while it could be quite good at insulating us from small local shocks, could be very bad when it came to amplifying large global shocks. And that is indeed what came to pass in 2008, 2009. We had, contagion on a global scale and on an enormous scale in a way that wasn't foreseen by anyone, with no exceptions. I mean, there have been lots of people after the fact that have exhibited, supernatural powers of hindsight. But truth be told, not a single person, with no exceptions, got this 100% right. And therefore, the right answer to the Queen's question, I think, was fair cop, actually. Could do better. And I hope over the 10, 12 years since, Alan, economists, policymakers have done a bit better, have learned some of the lessons from that crisis. I think actually policymakers and economists, and even economic policymakers like me, have had a somewhat better COVID crisis than they had a global financial crisis. And I think a not small part of that does come from having learned some of the lessons from that crisis, not least about contagion, this time not so much financial as viral, but nonetheless the scope for those cliff edge events, those big shocks in the tail of the distribution. I think that was a big lesson from the global financial crisis, and one we've taken forward in our response over the past 12 months. I hope we have, anyway.
I mean, I looked online just to see what I could find in terms of the Bank of England having made plans. And there was a paper from about 10, 12 years ago, which anticipated some of what might happen in the event of an influenza pandemic. But it bore no relation at all to the scale and the dramatic sweep of what's happened in the last year. I mean, is that inevitable? Is anybody to blame for that, or was it just unforeseeable?
I think to some, well, even if it's not entirely unforeseeable, I think it is a mug's game, Alan, to think you can predict with any accuracy the precise source of the shock, that it would be not just a global pandemic, but a pandemic of this type. I think it's also fanciful to think that we'll ever, with laser precision, determine the precise impact that will have. I think there's a high degree of unknowability of what economists are apt to sometimes call Knightian uncertainty. That is, those sort of Rumsfeldian unknown unknowns. That's out there. It's intrinsic to any complex adaptive web, any social system, certainly, that it has an inherent degree of unpredictability or uncertainty. Now, that should not, however, be a counsel of despair. There's plenty you can do to ensure against that uncertainty, or at least to ensure against the adverse consequences of those tail events, not the least of which is building a system, building a regime, building a financial system and economy that is robust and resilient to those sorts of tail events whenever they come and from wherever they come. You can build in those buffers. And that's what we've done with the financial system over the past 10, 12 years, that whatever the future shock, in this case a global pandemic, this time around, the financial system hasn't been the problem as it was 10, 12 years ago. In fact, this time around, the financial system has been part of the solution. And that would be the 1.5 million loans made to small businesses over the past 12 months. The problem, in a way, was that those lessons that we learnt back then about the resilience of the financial system weren't fully applied when it came to the resilience of our economies. And in some ways, that is one of the big learnings from the COVID crisis is that, I think.
When economic historians look at this in 100 years' time, how will this crisis compare with 2008?
Well, I think in terms of scale, it is already larger. In terms of policy response, it is already materially larger. I think, so in the sense of the collateral damage to incomes, to jobs, thus far at least, has been at least equivalent and in many respects larger than that of the global financial crisis. I think also, though, that given its very different source, that the duration of this crisis will also be rather different than it was back 10, 12 years ago. Back then, the crisis dragged on for at least the better part of a decade. We had subpar anemic growth, a lost decade, if you like, of pay rises for the average person, and pretty anemic growth from an historical perspective. And that's because at root, that was a balance sheet crisis. It struck the balance sheets of the financial services sector and thereby infected the balance sheets of companies and households. This time's crisis is rather different in its source, and thus far at least has had a less damaging impact on the balance sheets of households and the balance sheets of companies and the balance sheets of the financial sector. And that gives me hope, Alan, that the speed of bounce back as the vaccines come on stream will be materially sharper than it was after the global financial crisis. So some common elements, The collateral damage is a common element. The contagion, albeit a different type of contagion, is a common element. But I think the duration stands every chance of being rather different, a rather shorter, sharper shock than back then.
So the Daily Mail calls you Mr. Boom. So you, I mean, partly that may be temperamental, partly you may see it as your job to talk things up as opposed to talking things down. What do you think is going to be worse? I mean, there's obviously going to be huge unemployment. There are going to be a lot of businesses crushed by this. I think I've read you talking about the fact this is going to accentuate some of the inequalities, particularly generational inequalities. So with your Mr. Doom hat rather than Mr. Boom hat, what do you worry about?
Well, the things on my list of things to worry about, I think the ones you've mentioned there, Alan, would cover it well. I mean, of long standing, I've viewed unemployment as public enemy number one from an economic policy perspective. That's the reason I went into economics and economic policy. I mean, the good news there is that the government support measures, which have been, gigantic in scale, not just in this country but globally, have protected us thus far from the worst of the very sharp contraction we've seen in activity. If you'd asked me, back this time last year, if you told me back then we'd see a contraction in GDP of 25%, give or take, in the first half of the year, what implications would that have for unemployment? Well, your standard ready reckoners would say that would translate into a rise of joblessness, of perhaps, unemployment, looking at numbers of, 4 or 5 million people out of work. In other words, well north of the previous highest peak of just north of 3 million back in the early 1980s. In the event, the furlough schemes in this country, the job support schemes internationally, have really put the lid very firmly on unemployment. And my hope would be, that the lid could be kept on unemployment, provided the economy bounces back, as I expect it will, in the relatively near future. Even if that is the case, that doesn't mean there won't be some lasting scars from this crisis. And one of the larger of those, I think, will be a worsening of some of the distributional scars and the inequality scars that you mentioned. It strikes me as very likely that this COVID crisis will worsen pre-existing inequalities from a generational perspective, because all recessions hit hardest the youngest, and this one will surely be no exception to that rule. This COVID crisis will hit hardest those with fewest skills and lowest incomes, and therefore I think a second casualty will be inequalities of income. Funnily enough, a third dimension of inequality, which is a spatial dimension, the geographic dimension, I think actually might end up being made somewhat better by the COVID crisis. I think there's a chance that activity in jobs and businesses, and therefore incomes, will be more evenly distributed around the country off the back of this crisis. So those are all problems that will need to be addressed on an ongoing basis. For now, it's about protecting jobs, protecting businesses, protecting incomes. But as we emerge from this crisis, as the virus is beaten back by vaccines, it's tremendously important we don't lose sight of redressing some of those emerging inequalities by investing in younger people and their skills and their jobs, by helping support people on lower incomes with lower skills. These are all things that I think have to be front and center of the Build Back Better agenda. It's not a case of the government stepping back. It's a question of reorienting the nature of support from money spent to support jobs and incomes today to to investing in people's skills and jobs for tomorrow. That, for me, is going to be the crucial handoff during the course of this year, one of them at least.
Just to remind you, do start putting questions into chats, because the sooner you start asking questions, the more interesting it will get. Can we talk about the magic money tree? Is there one or isn't there one?
Well, I think not as conventionally defined, Alan. So what has happened, this was true pre-COVID, was that the Bank of England and many of the central banks around the world engaged in temporary purchases of government securities with a view to supporting the economy. And as best I can tell, had we not done that pre-COVID, we would have been looking at extra 500,000, 750,000, perhaps as much as 1 million extra people in this country, Alan, being out of work. That's what sort of salves my conscience when it comes to justifying what we call QE, what others call money printing, or even the magic money tree. We've been engaged in even more QE since the COVID crisis struck. In fact, we've more than doubled the stock of QE, or will have done once we've completed our program of asset purchases by the end of this year. And that's also very much been with a view to temporarily supporting the economy. The key point here, and the key reason why this is not sort of money financing or money printing or money tree horticulture, is because these are temporary actions to keep borrowing costs sufficiently low that they support incomes and jobs in the economy. That's what differentiates those acts from acts of money printing, of money financing, or of money tree cultivation. And that's an important thing to bear in mind, because as soon as the fiscal, as soon as the monetary tail is being wagged by the fiscal dog, bad things historically have tended to happen. That has tended to sow the seeds. That's been the thin end of a thick wedge that's resulted in inflation being too high. And the very last thing any economy needs right now, including the UK economy, is a bout of higher inflation that causes borrowing costs to rise and therefore puts back the prospects for the recovery. So that's a slightly long-winded answer to your question, but the stakes here are pretty high. So I wanted to provide a, sufficiently lengthy answer to make clear the importance of this issue looking forward.
You can see why people are confused about the discipline of economics and the way it's treated by politicians. Can I just read to you? I've been reading Lionel Barber's, my old colleague, his memoirs, and there's a very striking passage in which he talks about a lunch with Sir Jeremy Hayward. This was a couple of years ago. Hayward, who's usually guarded, confides that he's worried about developments at home, especially the impact of George Osborne's austerity programme. The squeeze on public spending underway since 2010 will be, quotes, very hard to maintain as the economy improves. Welfare cuts, 20 billion is apparently under discussion, are just not possible on this scale. The problem lies partly in Cameron's commitment to protect, it's longer than 2 years ago, obviously. The problem lies partly in Cameron's commitment to protect education, foreign aid and health services. This so-called ring fencing means that the choices are limited and other spending departments bear a disproportionate level of cuts. Hayward says the impact on criminal justice system and legal aid is a huge worry. As for the Conservative Party, Hayward says they're out of control, they've got no discipline. It's remarkable how the whole ideology of austerity has now been thrown out the window. So it was a given then, and it's the reverse even before the pandemic is true now. I mean, I know you travel a lot around the country. You must meet a lot of people confused by macroeconomics and the job of people like yourselves.
I do spend a lot of my time, or used to until recently, as you say, Alan, traveling around the country. I see it's a core part of the job. And certainly it's one of the things, one of the vehicles through which I gain the greatest insights on how the economy is doing, by speaking to the people that are the economy. That's not just businesses, although it obviously includes businesses. It includes community groups and faith groups and citizens directly. So I mean, harvesting their stories on the economy, their narratives, has for me been a absolutely crucial source of insight in making sense of what is going on and for understanding the puzzles that they're puzzling over. And there's no question, in the course of my conversations over many years, austerity came up a lot, and people had strongly held views on what austerity was doing to affect their lives, their livelihoods, and their communities. I mean, not wishing to relitigate the past, if I turn to the present, you're quite right. We've seen a very different macroeconomic policy package this time around. Central banks haven't been the only game in town. It's very much actually been the fiscal authorities, governments, that have been at the front line, providing what is, by any historical metric, extraordinary degrees of fiscal support. We're talking, 15, 20% of GDP in terms of fiscal deficits in the major advanced economies. And that was just what the doctor ordered. Fiscal policy is the right tool for reaching directly those most affected by the crisis. That could be people at risk of losing their jobs, or it could be businesses at risk of going bust. Fiscal policy, government action has that surgical precision to reach into those most in need and to provide support in the forms of income or support or jobs. And that's what it's done on, as I say, an extraordinary scale. Monetary policy does not have that surgical capacity. It's a blunt instrument. It can lower borrowing costs for companies, for households, but cannot target that support to particular households or particular businesses. So that this time's policy package has been fiscally front-loaded and targeted, and that monetary policy has played a supporting role, I think has been absolutely right. And I hope that's a lesson that will stick with us, well beyond this crisis, that fiscal and monetary acting in partnership is the best sort of response to this type of event.
Right, we've got lots of questions now, so this is great. And I'll call your name, and if you want to come forward and ask a question yourself, that would be great. So Charlotte Appleby.
Andy said that this time unemployment hadn't gone up as it did in the previous crisis. Why does he think that it hasn't simply been postponed by the furlough scheme and we just haven't seen it yet? I hope it won't, but how do we know?
Alan, shall I pick these off one by one? Is that the best way to do it?
Yeah.
Let's do that. Thanks, Charlotte. I mean, that's a very, very good question. This is really going to be depend on two things, the balance of two things. The first of which is when it is the CJRS, the furlough scheme, is turned off. The Chancellor's already extended that to the end of April. He's also shown his capacity, from past actions, his willingness rather, to flex the timing of that furlough scheme. The other important factor is how the economy is doing at the point the furlough scheme rolls off. How far below its pre-COVID levels are incomes and activity in the economy at that point. If the economy has recovered sufficiently at the point the furlough scheme tapers, there's no reason to expect any further losses of job at the point the furlough scheme tapers. So, for example, if the economy is, say, within 5 percentage points of its pre-COVID level at the point the furlough scheme tapers, I would not envision any further losses of job than those which have already taken place. Bearing in mind that I think already about 1 million people across the country have lost their job. That's not showing up very clearly in the unemployment numbers at the moment. But my best guess from some of the government data, administrative data, is that about 1 million more people are unemployed than was the case a year ago. If the economy is back to within sort of 5 to 10 percentage points of its pre-COVID level, I wouldn't expect any more people to be made unemployed when the furlough scheme tapers. And if we get that recovery that I expect to start coming on stream, probably at a rate of knots from the second quarter, that will hopefully then eat away and improve the prospects of re-employing those 1 million people who have lost their jobs. Ultimately, there's a timing question, timing the end of the furlough scheme in such a way that the economy is recovered sufficiently to prevent any further losses of jobs, Charlotte.
Hannah Berendt.
So my question relates to, we're talking about the recovery in the economic terms, but what would you suggest that the government could do better in terms of learning and building back better from the current crisis? So thinking especially about things like climate change and regional inequalities. So I think we really have a huge opportunity here, but sort of thinking about policy making, I think there's also a large risk that might be missed in favour of quickly trying to return to the old normal.
Yeah, I think, Hannah, you raise a very good point. I think some of the issues you raise are going to be crucial the recovery will come, but the key is to have that be a sustainable recovery. It's not just a release of pent-up demand, but it's a recovery that can persist over the medium term. And that's why this toggle from spending for today to spending for tomorrow, from consumption to investment, is so crucial. And as part of that handoff, that toggle by both governments and by businesses, we should think about, what it is we want to invest in. And for me, two of the absolute North Stars, if you can have two North Stars, of that investment agenda would be the two issues you mentioned, which would be the net zero target for 2050, or perhaps even sooner, and levelling up the economy at a spatial level. There's others we could throw in the pot, but those would be two good places to start. And it's not me who'll decide this, it will be government. But I think looking forward, I think I would have those objectives as being the golden threads that run through every policy choice we make hereafter, every investment decision we make, whatever the government department, that running through that is the question, will this support the government's net zero objectives 2050 and its levelling up objectives across the country? I could speak a little bit more if you're interested in specific policies that would facilitate those levelling up agendas and those net zero agendas. But the key point for me is that those missions, those medium-term objectives, those investments are a core ingredient of every policy choice we make as we enter the recovery phase.
David Tritch.
Hiya. I had a short question, which was that I read a Financial Times article a couple of weeks ago that said that a majority of players in the market for UK government bonds think that because this time is unlike the 2008 crisis, at this time QE had been calibrated to absorb the flood of extra bonds that's coming on the market, government bonds, so basically propping up government debt. And whether that is true or not, surely it still poses a crisis in confidence in the Bank of England. Would you agree with that? And if so, how do you think the Bank of England could resolve that crisis of confidence?
Thanks, David. Well, you'd be unsurprised to hear, familiar with that survey. It was a survey of fund managers who were asked, why do you think the bank has been doing this thing called QE? And by and large, they felt that we were doing it to sort of finance the government's yawning deficit rather than necessarily for monetary policy purposes. You'd expect me to disagree with that, and I'm going to. And the reason for that is, and this is going to be familiar to all of you that are students of economics, or indeed students of any subject, which is that we must not confuse coincidence and causality. The story of the last 12 months is actually very simple. We have had a whopper, technical expression, whopper shock to the economy. GDP falling by a quarter in the first half of last year. In response to which, we have seen a whopper response by both governments in the form of fiscal policy. That's where the deficits become 10, 12, 15, 20% of GDP. And a whopper response by the monetary authorities in the form of QE offering monetary support. That doesn't mean that fiscal dog is wagging monetary tail. It's just that we've had a big shock, a common shock, to which both monetary and fiscal policy have responded. That's why QE and fiscal deficits have gone up at the same time, not because one is causing the other, but because a big shock, the COVID crisis, has been common cause for both. Now, that's the defensive part of my answer. Let me give you a slightly more nuanced response, though, which is, does it worry me that people harbour these perceptions, that they think actually that monetary policy is being dictated by fiscal concerns? Is that a worry to me? Yes, and I've spoken in public about my degree of concern about those perceptions, what it might mean for people's perceptions of the Bank of England's independence. Ultimately, what will alter those perceptions and what will re-establish independence or re-establish or remove people's concerns about independence is not the warm words that I use this evening, but the actions taken by the Bank of England as and when the recovery takes hold. That means if there is a sign of monetary tightening being needed because the economy is recovered fast, or because there's a chance the inflation target might be breached, that we take those actions in an operationally independent way to meet our mandate, to meet our inflation target. Ultimately, that will be the proof of this particular pudding. And I'm confident that in that situation, I have a personal accountability to Parliament to take the actions necessary to meet the inflation target. And I will be in breach of my statutory duty if I don't take those actions. I'm pretty confident personally I will take those actions as necessary to bring inflation to heel if that's needed down the track. And that's the thing I think we should always remember, that we have the institutional machinery and the statutory framework that requires the Bank of England to do the right thing, not in response to fiscal needs, but in response to the needs of the economy and the inflation target. I hope that helps a bit, David.
Thank you so much.
Nicola Stevenson, you're there with a couple of short, sharp questions there. Do you want to come in and just ask those? And Nicola, your line's not much good, but I'm hoping Andy caught that. It's essentially why are public sector 0-hour contracts not included in the furlough scheme?
Yeah, it's probably, Nicola, a question. This is not me passing the buck. It is a bit actually. A question for my colleagues in Treasury rather than for me. But in generally speaking, I mean, the furlough scheme is being used to support the government supporting jobs primarily in the private sector, though also in the charitable sector as well, on the grounds that the government is already supporting, if you like, jobs that exist in the public sector more directly. So I think that was the underlying rationale for the design of the scheme, but I will defer to my Treasury friends and colleagues on the specifics of how that scheme has been designed and implemented in practice.
Question from Guy Monson, an alumnum, now distinguished investment banker. Would you ask Andy whether the increase in public debt as a proportion of GDP to more than 100% for the UK and much of the Western world has economic consequences? Does it increase financial stability, or, as in the case of Japan, is this something we can learn to live with?
Yeah, thanks. Another great question. I think near term, it's absolutely was necessary to use the public sector's balance sheet, if you like, to cushion the effects of this awful crisis on people's lives and people's jobs and people's businesses. It's true that 3% of GDP can sound like a scary debt number. It's a bit less scary if you look at it through a slightly different lens. I mean, one of those lenses would be historically. There were more years during the 19th and 20th century when government debt to GDP was above 100% of GDP than it was below. So this is not by any means, in any way, shape or form, unprecedented territory for governments, even in debt stock terms. And of course, a second crucial factor here is that the cost of servicing that debt has never been lower in human history. So although the debt stock has shot up very rapidly due to those fiscal deficits, the cost of servicing that debt is actually lower now than it was 12 months ago, because the lower cost of borrowing has more than offset the higher debt stock. And that too should give us a degree of comfort that we're not facing any impending fiscal problem or funding strike. Final point on this, and it's an important one looking forward actually, is that if you did think that the debt stock was uncomfortably high, despite the fact, as Alan said, that many countries have, including the UK, have lived with debt stocks that high for a long time, if nonetheless you were still concerned about that vulnerability and wanted to get that debt ratio down, I think another of the key lessons of history is the mechanism by which you do that. The most successful mechanism by which you do that is, if you like, by growing the denominator rather than by shrinking the numerator. That is to say, growing the economy is the most cost-effective means of getting those debt stocks down. And that really speaks to Hannah's question from earlier on, that we need a strategy for sustainable recovery that can boost growth and use that as the mechanism by which we lower the debt stock in relation to GDP. That's an important policy lesson looking forward, I think.
I'm going to ask Natalie Quinn, who's one of our economic fellows who sent me some questions in advance. Monetary policy in the UK has been in unprecedented and presumably unsustainable emergency measures for over 12 years with no end in sight. So various questions arise. One, how can this situation be unwound without precipitating a crisis? Two, the policy instruments employed have led to a hidden but regressive redistribution of wealth through inflation of asset values. How can such real economy distributional impacts of monetary policy be justified? And three, are the issues being addressed by monetary policy really short-run monetary issues amenable to monetary policy instruments, or symptoms of a much longer real economy issues that can never be solved through monetary policy?
Well, thank you. Those are great questions, Natalie. Let me maybe answer them in reverse order, actually. Monetary policy can provide no more than a temporary cushion. It is no more than a temporary bridge. That was true after the global financial crisis. It's true after the COVID crisis. Monetary policy can't create businesses. It can't durably grow skills or jobs or build houses or bridges or broadband. All of those are the realm of government. All of those are the realm of structural policy. All of those are the realm, actually, of industrial policy. So as one of my side hustles, Alan, I chair the Government's Industrial Strategy Council, and it is really very much charged with thinking about those structural policies, skills, education, innovation, infrastructure, investment, levelling up. And those hold the absolute policy key to growing living standards, to creating jobs, to growing pay packets, to growing great businesses. And monetary policy can't do that. It's only there as a temporary, short-term salve for our scars. And that's true this time, it'll be true in future as well. So absolutely, I'm with you, Natalie, that government policy, structural policy, will be the name of the game in tackling those structural fault lines that you mentioned and that have loomed large for rather too long, I would say. On the impact that our monetary policy actions have had, a lot has been written about how QE, how money printing, by inflating asset prices, may have worsened pre-existing inequalities in wealth. That is a very serious issue, a very serious accusation. And it's one that I personally have taken very seriously and have analysed in quite a degree of depth. In fact, I've analysed it pretty much household by household across the UK to assess the extent to which monetary policy might indeed have made a bad wealth inequality situation worse. And as best I can tell from that very detailed analysis, it's published research, that by and large has not been the case. And the reason for that is because, for all the fact that QE may have boosted asset prices, indeed that's one of the mechanisms by which it works, it has also served to boost jobs, and in particular jobs for those that are least well off in the economy. That's that 500,000, 750,000, 1 million jobs, Alan, I mentioned earlier on. And if you look at how those two effects have panned out, I don't think QE has in fact made either wealth or income inequalities worse. If any, for the larger number of people, it's actually made those inequalities somewhat better by putting people in work, in jobs and earning. And that's one of the reasons I can sleep at night, actually, that having looked at this every which way, having sliced the data every which way, I actually don't think QE has made inequalities of wealth and of income, or indeed of generation, any worse. It has, by and large, lifted, if not all boats, then the vast majority of boats, not least those of the poorest and least advantaged in society. And the final part of Natalie's question, I'm sorry to give so long an answer, was having got in deep. I mean, bear in mind, as I mentioned earlier on, we have announced more QE over the past 10 months than we executed over the preceding 10 years. That means we at the Bank of England are in deep, almost £1 trillion of government assets on the Bank of England's balance sheets and similar amounts in central banks around the world. I mean, the short answer, how do we get out of this, is slowly, is gradually, is not taking action that precipitate too much noisiness or friction or instability in financial markets. And when the time does come to reverse direction, to sell those assets, we'll do it in a gradual fashion that I hope causes the least amount of financial noise and ultimately financial pain.
Christopher Coombe, you had a question a bit earlier, but I think it's still a relevant question if you're there.
I'm here. Thank you very much, Alan. I was really interested in your vice chairmanship of the Numeracy project and seeing what that does as a charity, and thinking about skilling young people, as you described, an essential requirement at the moment. Is this a charitable project, or should upskilling young people be a government project?
Yeah, very good point, Christopher. So you're right. Of all the UK is facing many crises right now. There's the COVID crisis and the climate crisis. Let me add one more to your list, which is the numeracy crisis. Yep. We are very largely and very regrettably an innumerate nation. Getting on for half of the working population has maths that are no better than those of a primary school child. We're the only OECD country that's getting worse over time. The only OECD country for whom the level of maths, standard of maths of our 55 to 64-year-olds is better than that of our 16 to 24-year-olds. This really matters because, by and large, it's hard to get on in the world of work without essential numeracy, not mathematics skills, not Pythagoras' theorem. I'm talking adding up, subtracting, multiplying, and dividing, knowing, what a percentage means. My day job is setting interest rates. It's pretty tricky if people don't know whether a rise in interest rates is good or bad for them. But that is the plight of many people across the UK. Your question, Christopher, though, was how much of this is responsibility of government and how much is it responsibility of charities like National Numeracy? Inevitably, I think it is a joint responsibility. I do think the time has come for a relook and a rethink and a refresh of how maths is taught, because it's plainly putting off a lot of people right now, not least those that are most in need of some core level of numeracy. However, if we only tackle this through education, we're going to leave behind those many millions of adults whose skills do need to be refreshed and improved already. So I think this needs to be a twin action from both governments in how it thinks about teaching and training in numeracy, but also actions by third sector organisations, including National Numeracy, to fill in some of the inevitable gaps. Such is the scale of this challenge. I think we need private sector, public sector, and social sector acting in partnership to scale and tackle this crisis. I think all three have a big role to play. Actually, not just in this crisis. A key building back better point here, a generic point, is that we need public, private, and social sectors acting in partnership, as they have so effectively during the course of the COVID crisis. This should not be an ideological debate about market versus state. We need, as the COVID crisis has shown, we need both, and we need, in addition, the social sector filling in some of the cracks. With the public sector acting as it has, as this crucial insurer of last resort, we need businesses acting in a much more purposeful fashion in supporting their employees and customers and clients and communities. We also need a rethink and revitalization of the social sector, of charities and community and faith organizations, because they too have been one of the key unsung heroes of this crisis. Indeed, one of the key unsung heroes of every crisis, if you look back over the history books over the last 250 years. That's a slightly longer-winded and more expansive answer, Christopher, to your question than I'd planned. I think it's important to set the numeracy crisis in the context of those other challenges that we face, each of which will require this partnership, this three-pillar model, if they are to be successfully tackled.
Laura's question was, will restoring growth following a COVID-19 pandemic in the southeast and London come at the expense of resources being disallocated from northern powerhouse projects?
Well, I hope not. I actually think not as well. We're in some ways, we have a divine coincidence at the moment on the levelling up agenda, because it turns out, what is politically expedient also happens to be socially just and economically coherent. And that is one of the things that gives me hope that we will make good at long last on what is these days called levelling up the country. The truth is that spatial inequalities here in the UK, are larger than those in pretty much any other advanced economy, and at their largest level, those inequalities for at least 100 years, late Victorian times, to find such a degree of spatial disparity. As I hinted earlier on, I actually think that the COVID crisis might, funnily enough, provide us with a tailwind in helping achieve that levelling up. I think we will see something of a decentralization, a movement. Pre-COVID, the magnetic attractions of our big cities, not just London, but including London, were very considerable. The magnetic attraction of people and businesses and finance and commerce and culture. I think whereas urban density was a big asset pre-COVID, it has become a big liability in the light of COVID, and that in future, this more decentralized approach to where we work, to where we set up businesses, will persist to some degree, and that will provide that tailwind to us spreading activity in jobs and businesses and cultural activities more evenly across the country. I think absolutely it's the role of governments to support that, to support those trends, not least in how it governs the country. So there's, for me, no hope of making good on levelling up incomes and jobs and businesses unless we level up the distribution of powers and responsibilities across the country. We have a devolution white paper coming down the pipe, probably for the second half of this year. And for me, that is the real opportunity to devolve to a much greater degree than we've seen over the last 50 years, powers and monies and peoples. Those are the holy trinity. You need all three: devolution of powers and monies and responsibilities, if we are to make good on levelling up.
We're nearly out of time, but there are a couple of great questions at the end. So if you can give us 5 minutes more, Andy. Your fellow Yorkshireman, Daniel Hussain. Daniel.
Hi, Andy. Now more than ever, we live in a world fraught with misinformation. How do you think the Bank of England, as an independent body, can deal with this, given how confidence in the economy is volatile?
I think it's crucial. I think it's one of the key benefits of having an operationally independent central bank, that we can tell it as it is. Alan mentioned earlier on that, crucially important right now is that we provide at the bank an objective reading of the economy. I wouldn't see that as egging the economy on. I'm not overstating the good news. What I see myself as doing is redressing the balance that we sometimes see in commentary, in focusing overly on the bad news. So I think it's crucial that the bank plays its historical role in providing a objective reading on how the economy is doing, whether that is good or whether that is less good. I think it's also crucial, and I hope we've made some big strides on this front over the past few years, that the Bank of England speaks to all of its stakeholders. For too much of the Bank of England's 326-year history, we have spoken largely, sometimes exclusively, to those in the square mile that is the City of London. But we are the central bank for the whole of the UK, and for every citizen in the UK. So absolutely crucial that we engage in conversations, two-way conversations, with each and every part of the UK. We've made some strides on that front of late with our town halls, with our citizens panels, to ensure that, we don't just talk to everyone as our stakeholders, but that they talk back to us and give us their reading on how the economy is doing. And in these days of of sometimes distorted social media, of fake news, the need for that authoritative voice of institutions that can stand aside from the daily politics and the daily media clatter and provide expertise and experience on how the economy is doing, how the financial system. I think that has never been more important than now. If you look back through history, what are the core ingredients of mass flourishing of our economies and our societies? It is the capacity to have institutions that can provide that authoritative voice and can take those authoritative actions. And never of those institutions, within which I'd include Alan's former employees, the Fourth Estate, the media, never have those set of institutions, broadly defined, been more important than now in securing not just an objective reading of the facts, but also securing the policies we need to fuel recovery.
There are so many great questions in chat, but we have to end. So thank you for your questions. Thank you for coming. I'm going to give the last question to another Andy, Andy Hallam, who is the excellent Vice President of the JCR and has got a good question about growth and climate. Andy, where are you?
Thanks very much for being here, Andy. So my question was, do you think that going forward there's going to be increased conflict between markets want for continual growth and environmental limits, and as a result of that, do you foresee a point in the future where we stop using GDP growth as the primary instrument of measuring the success of an economy?
Yeah, thanks, Andy. Another great question. I apologise for not getting to more of your questions. That's a legacy of me whittering on too long with my answers, which I apologise in advance. I think there need not be a trade-off if we are savvy about this. The truth is, what better time to make an investment in green technologies than now? That works for meeting our net zero objectives, and it works for boosting jobs and incomes in the recovery. So for me, just at the moment, there absolutely is a double coincidence of wants. There's no necessary conflict between our green objectives and our growth objectives. That was very clear, actually, back in Nick Stern's report. The Stern report, the bit that everyone remembers, is the stuff about risks, and people acted on those risks, and just as well they did. But as an important part of Nick's report was the opportunity presented by the climate crisis to reinvest in the technologies we need to create a carbon neutral future. And what better time than now, when we need that growth, we need that sustainable recovery, we need that investment, than to make that investment in green technologies. Point one. Second point was, could I imagine a point in the future where growth, where GDP is not the be all and end all, the North Star of economic policy? Yes, I can. And I hope that day comes along sooner rather than later. I'm on record as saying that I think as we look forward, embedding notions of well-being or happiness in the way we keep score on success, not just in the economy, but in society, is going to be absolutely crucial. And just to demonstrate that, well, one very simple example that actually relates back to an earlier conversation we had. Someone said earlier on, would it be the case that, when it comes to the recovery, all the money goes to London and not enough to the regions? And that's definitely a risk. I think that probably shouldn't be the case. Nonetheless, if you look at the economy through a somewhat different lens, through a well-being lens, actually the most miserable place in the country, in the UK, by some margin, is London. So although London is top of the pops when it comes to income and wealth, it's bottom of the charts when it comes to well-being and welfare. And that, for me, makes the point that looking forward, a more plural set of metrics, ones that pay much greater heed to how we feel as much as how much are in our bank accounts is going to be absolutely crucial. If the last 12 months has taught us anything, I think it's that important lesson.
Thank you so much, Andy, for coming along tonight, for speaking. I don't know how you do it. I would be so terrified of saying something that was going to be all over the front page of the Daily Mail and moving markets. I would be mute, but you speak incredibly fluently and confidently and directly and entertainingly. So it's been a real privilege to have you. We can't see you, but I'm sure everyone's putting their hands together, and I hope when all this is over, you'll come down and we can treat you to a famous LMH hospitality. Thank you for coming.
Thank you, Alan. Thank you, everyone, for the fantastic questions. I really look forward, Alan, in the not too distant future, to taking you up on that offer of a dinner down in Oxford. Thank you.
Okay. A boom special. Thank you.
Thanks, everyone.